Great, thank you. Well, welcome to the webinar hosted by Catholic Investment Services. Thank you for joining us today for a discussion of venture investing. My name is Tom Langto, and I'm privileged to serve as Chief Executive Officer of Catholic Investment Services. My colleague, Zayla Astarjan, has done a great job organizing this program and is at the Zoom controls. Catholic Investment Services was founded by some of the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit providing investment solutions for other Catholic nonprofits and their investment consultants, and now manage almost $1 billion of client assets in 4 different strategies. Enormous thanks to our all-star panelists, whom you'll meet shortly. Today's format will be conversational. There'll be time for audience questions during and after the formal part of the program, so please use the Q&A feature on your Zoom screen to submit a question. Our audience is muted. Program is being recorded and will be available for replay on our CIS Institute webpage and in podcast format. You received biographical information for our panelists, but I want to emphasize a few highlights. Earlier this year, Forbes magazine ranked Tim Connors number 23. Tim, that was Michael Jordan's number, wasn't it?
I think you're right.
23 on its
and Kristen Press on the U.S. women's national team.
All right, good. On its list of Midas seed investors. Tim's Pivot North funds provide early stage venture capital to computer scientists who want to disrupt important markets in ways that advance ESG principles and improve the lives of the underserved and poorly served. Tim is a hands-on coach to the founders he supports and applies the same thoughtful and provocative style as a leading Catholic layman. In addition to service to his parish, and we're talking about Tim's now got a new parish now in Nashville, the Archdiocese of San Francisco, which he just left, and Notre Dame, Tim is an active board member of Fatica and uses his STEM brain for the greater good. CIS has no bigger advocate or better friend than Tim Connors. In Michael Kim and Miguel Luina, we have 2 of the world's most accomplished and thoughtful venture investors. Michael founded Sendana Capital, which invests in small, early-stage venture capital funds globally. Hamilton Lane is one of the world's largest allocators of capital in private markets, and Miguel leads the Hamilton Lane's efforts in venture and technology investing. Michael and Miguel invest with the best of the best, and we are especially grateful to have them join us today. Today's innovators are driven by purpose and profit, so we hope that this program provides some useful take-home value for Catholic institutions wanting a better understanding of venture investing and how it might align with their investment objectives. Tim, Miguel, and Michael, thank you for contributing your time, talent, and experience today. Before we begin our program, please join me in a short prayer. Veterans Day was observed last Friday, so let us thank and pray for the safety of the women and men who serve us in the armed forces, and remember, thank, and pray for all veterans and their families, especially those who have suffered as a result of their service. And as always, we pray for peace, and we offer prayers and thanks for the women and men religious, their lay colleagues, and so many volunteers who, through their work for Catholic ministries, have devoted their lives to something bigger than themselves. Amen. Tim, take it away.
Well, thanks for having us. So Michael and Miguel, maybe just for starters, each of you could talk a little bit about, describe what venture capital investing is and why you think it's a great fit for Catholic Foundation asset allocation. Maybe Miguel, you start.
Sure, happy to go first, and thank you very much for inviting me here. Very excited to be here. So, look, so we are Hamilton Lane, as kind of within the introduction, we are one of the world's largest allocators of private market capital. We do everything within the private markets, and nothing essentially kind of outside of that. But when we look at venture investing, what it is, how it fits in the portfolio, venture investing is really investing into the creation of companies. So we're starting new enterprises, and it's a way to really invest into emerging technology. So as you think about kind of the global landscape and you look at kind of a broadly diversified portfolio, there's your kind of large incumbents, there's kind of strategic diversification. Within venture, you're really investing in an area where you're developing new technologies, you're creating disruption, but you're kind of taking advantage of that. And so it's a good way to create some diversification within your portfolio, create some exposure to the next generation of technologies.
Michael?
I'm happy to also add that, I think the way I think about venture is that pools of capital from those who have it are being invested in founders. And venture capital, I think, has always been about the entrepreneurial spirit. And while modern venture has been around since the late 60s, so not that long ago, 50 years ago, what I would say is that risk capital has always been used. For example, Christopher Columbus coming to the United States or coming to the Americas, and the king and queen supported that venture. In fact, just as a side note, the carried interest that people talk about in venture, which is this little bit of profit that's allocated to the manager, is actually from carrying the goods across the ocean. And so what it really enables, I think, is that individuals can express their freedom and desire to create something that they really are passionate about. And if the idea is good, if there's an opportunity for that company to become bigger and serve people, venture capital will be there to do that. And it's in stark contrast, actually, to my example about Christopher Columbus. It's private capital. It's capital that's being provided by universities, endowments, charities, not-for-profits, individuals, family offices, and groups like that. And they are taking that risk. But what it ultimately enables is the progression of human knowledge. And I think it actually makes the world a better place.
So Michael, how do VCs find that founder that you talk about? Because obviously not every startup works. So how do you find the founder that's going to outperform?
That really is the magical thing. People in venture talk about pattern recognition, computer science major coming out of Stanford, working at Facebook. Those are sort of markers that people look for, but I think they're wrong. I think the most interesting founders don't fit any sort of pattern and is really driven by passion. What are they trying to accomplish? Why are they trying to accomplish this? And how are they going to accomplish this? And I think the job of a venture capitalist is to identify founders that are going to be amazing, even before the founders themselves know that they're going to be amazing. And so it's really driven by passion of the founder, the idea, and whether they're going after a large enough market, and from a business perspective, whether that idea is going to generate a positive cash flow. Because obviously, you don't want to spend $2 in marketing to get $1 of revenue. So those are upside down businesses. Those are just are being fueled perhaps by momentum. But ultimately, the best founders are the ones who have that grit and perseverance and that determination in order to create something. So in a way, it's very magical that venture capitalists can actually find these founders who have that, and not necessarily the ones who have those sort of credentials that most people point to. So I do think that that's in a way, a black box. And so in fact, I would turn that back to you, Tim, and say, how do you find amazing founders that have gone on to create very substantial businesses?
Yeah, it's really three attributes I look for: smarts, goodness, and grit. So you gotta pick a market that matters to people, first of all. But if you get the market in an unmet need right with a founder, if the founder is smart, startups have a limited amount of time, so you need a fast motor. So founders have to learn quickly. So it's typically top 1% on the raw intelligence scale are the founders that succeed, both book smarts and street smarts. Grit, if the going gets tough, do you quit or do the legs keep driving? Startups seem glamorous in the press when they work, but there's a lot of times that founders can quit. And then goodness is really near and dear to this group, kind of three attributes within goodness: empathy, self-awareness, and moral compass. So startups are an act of empathy. So put yourself in the shoes of the customer you're trying to serve, understand their needs, put yourself in the shoes of that amazing talent you're trying to hire, and can you move them in a win-win way to join you and join your mission. Self-awareness, do you know what you're good at, not good at? So you're honest with your coaches so we can coach you. And then moral compass, do you always do the right thing when nobody's looking? And there's plenty of news in the press about the folks who fail on that last one. And when they fail miserably on that one. So if they've got smart, goodness, and grit, and they're trying to solve a problem that really matters to the world and to them, we can usually coach them to have good success.
That one thing I would add to that, and perhaps it's just a way of rephrasing it, but I think founders, when it's at the very earliest stages, they're still trying to figure out product, market, and fit. And so they have to have, I guess, humbleness in order to admit that this current path is wrong, and then they have to pivot. You may hear about pivoting in venture. It really means that they're going to try something new, and it's really having that open mind and the humbleness in order to recognize that the current path may be wrong, and they have to adjust accordingly.
Yeah, it's a fascinating combo of being confident, but also being self-aware.
Right.
You got to sell, but you also got to know what's real and what's not quite real. Miguel, so big Catholic university endowments like Notre Dame, Georgetown, et cetera, have been super deep in venture capital for many decades, and it's been transformational for their returns in their endowments. But a lot of other Catholic foundations and many dioceses have not been allocating to venture. Why do you think that is? And what's changed that's causing more momentum now for them to invest in venture?
Look, I think it's a good question. I mean, I think when you look at the venture industry, there's a ton of opportunity, and you can kind of see it in the headlines of success stories. But it's also a strategy that takes a lot of investment, a lot of time. It's not the easiest thing to get into, and it really takes kind of a concerted effort. And so if you are a larger institution, you have a staff of investment professionals that are spending their time within the venture world. You have long-term dedicated capital that is meaningful to the venture community, and you can develop long-term relationships with best-in-class managers that are going to generate the top performance within venture. And we can get into some of the details of why, but it's really important to invest with the best venture investors. And the way that I look at the industry, it's almost like it's on its head from the way traditional investing works, in that there is a science to identifying top founders. Many founders are repeat founders. Many founders have been that are kind of highly sought after by venture firms, have been incredibly successful within their life. And oftentimes they have their pick of which venture fund that they actually want to work with. And then those venture fund managers have their pick of which LPs they want to work with. And so there's kind of an incremental kind of selection that kind of goes into this. And so it's really important for an LP to be an attractive investor for those venture managers. And you really do that by being long-term investors within the asset class, developing a really strong reputation and network within the space. And that's something that's been really challenging for smaller investors.
Yeah, Tim, one thing I would echo is that perhaps, thinking about it in terms of just asset allocation, certainly it's easier to invest in public equities, in public markets. You just buy an ETF, right? And anyone can do that. You can go on E-Trade and click a button. I think with private markets, both private equity and venture capital, it really is having access to the fund managers. And then, the question is, okay, well, I now know that in venture, there's maybe a handful of fund managers I want to be with. I'm going to go in, I'm going to invest with them. But that, as Miguel points out, the top managers actually have significant say over which LPs are part of their fund. And I think that access question really limits the ability for a new limited partner to join, to come into a fund. And the other thing, is really, quite frankly, is that in order to access these best managers, you have to have the relationships. You have to spend the time with them, and what that really entails is that your investment team, if you have an investment team, is substantial enough that you can actually go out and meet these managers and also find new ones. So I would say that the smaller entities, a high school endowment, a small college endowment, they don't have the resources in order to spend time building the relationships in the private markets, both venture capital and private equity.
So Michael, talk a little bit about your business model and how fund of funds help with that kind of access.
Sure. So Sendana Capital is a fund of funds. I am the founder. I started about 11 years ago. Today, we have about $2 billion under management, and our LPs are large endowments, not-for-profits, family offices, and individuals. And we specifically look to invest in what essentially is very early stage venture funds around the world. And the way the business is set up, we have our investors that invest with Sendana, and then we take that capital and invest in these small early stage venture funds. And the way I have set up Sendana is that our investment approach is that we want to be the lead investor in the funds that we work with. And what I mean by that is, if you take a small venture capital fund, let's say it's $50 million, they may have a number of limited partners, endowments, foundations, individuals, family offices. We want to be the largest. We want to be the largest by size and by influence. And we work very closely with our fund managers. So for example, with Tim Connors, with you, Tim, we have a monthly call where we're comparing notes about what we're seeing in the market, hearing things, progress about your portfolio. But more importantly than those monthly calls, we actually, I think, have a strong relationship with you. And so we're always texting and emailing and comparing ideas and really working as a true partner. So that's the Sendana approach, is to be the lead investor with our portfolio funds. And we think that having that really tight, close relationship is beneficial for both us and for our fund managers.
So you invest in funds. So you pick venture managers. Venture managers turn around and pick founders.
Right.
And then, so folks can either invest in a fund of funds like yours if they want exposure to venture, or can invest in the managers directly.
Well, yes. So let me elaborate on that. So our largest investor is the University of Texas. Today, they're a $60 billion university endowment. They are so large that they actually cannot write small checks. And the funds that we pursue in our strategy are generally under $100 million. And you can imagine the University of Texas has to write very, very large checks. So, ideally they're writing $100 to $150 million checks, which just wouldn't work with seed stage funds. And so they essentially outsourced access to the seed stage venture to us. We work with groups like the Children's Hospital of Wisconsin, or the Gerber Foundation, which focuses on pediatrics. And those type of entities don't have investment teams. And so they just don't have the team to go out and find these funds. So they've outsourced it to us. We have larger groups, for example, like the St. Jude's Children's Hospital in Memphis, close to where you are, Tim, I suppose, that has an investment team, but it's small. There's 2 or 3 people on it. And so in a way, they're outsourcing sort of this net in order to go find interesting fund managers for their program. And they are actually co-investing alongside us. That's the plan, that they invested with Sendana, and together we look for fund managers where we source fund managers for them to go into directly. So you can see how some groups are just outsourcing to us, either because they're too large or because they have no investment team, or we work with groups like St. Jude's Children's Hospital, where we together find investment opportunities, and St. Jude's ultimately would go in directly.
That's great. So Miguel, mission matters a ton to the Catholic organizations. And for a long time, kind of what you did in investing your corpus, your endowment, was not something that could positively impact the mission. That's improving quickly with ESG on the public equity side. And it was interesting on a recent CIS panel where they talked about the data says you get 200 basis points higher return if you invest with ESG versus not with ESG on the public equity side. Talk about on venture capital, kind of what's coming out of the startup tech industry that's mission aligned and going to move the needle for the folks that the Catholic foundations and dioceses and endowments care about.
Yeah, look, it is our experience that the same metrics that apply to outperformance within the public markets apply to outperformance within the private markets, and specifically venture capital as well. And so, one of the areas that we've invested most heavily into over the last few years has been our focus on ESG investing as well, which we review every single manager for ESG investing. It's been, our experience that, to your investment approach of how you find founders, it's similar for us on how we find managers, people who have a long-term view of doing good things for the world, investing in business that are going to have long-term sustainable impact, are not going to be kind of a leech on the global economy, are poised to outperform in the long run. And venture is a very long-term asset class. A lot of times companies are being founded, they're not going public for another 10 plus years. And so you really have to believe in the long-term future of these businesses. And so, some areas that we think are, particularly attractive today is kind of the energy transition, getting away from fossil fuels and moving into kind of the electrification of our world. We have a lot of investments kind of outside of that as well. And so, one of the core makeups of venture portfolios is software. Software represents over 50% of the venture market. A lot of that is enterprise software. Some examples of, or a good example of enterprise software, a company that fits squarely into that would be Benevity. Benevity is an investment that we have through our portfolio. We also doubled down into it because we really liked the profile of the business. So Benevity provides software to institutions to help their employees become much more engaged in charitable giving and also volunteering. So that platform logged 23 million hours of volunteer time that otherwise would have been very difficult to coordinate. Another example is a business like Afresh, which is a software business that manages supply chain and inventory for grocers and for restaurants. And so when you think about kind of the efficiencies that can come out of the market, that is a business that aims to save over half of all food waste created in the US. So you can think about kind of the meaningful impact that has on ending starvation and on providing kind of better nutrition to places. And then the healthcare space is full of really interesting opportunities to kind of improve our lives. So Vicarious Surgical is a good example of this. Is a kind of machine supported surgical platform, helps doctors be much more effective at performing surgery, so really improves the success rate. But it also democratizes the access to healthcare, especially to kind of underserved areas where with this system you can do virtual surgery. So you can have a doctor that's based in the city and be able to provide care to anybody anywhere in the world when they have this system. So really kind of meaningful impact in terms of overall kind of human experience, and that really, in our view, kind of translates to returns as well.
So tell us a little bit more about Benevity. That's 23 million hours of volunteering. That's awesome. So
That's
talk
right.
a little bit about the business model and how they kind of how they work with Catholic charities or other Catholic nonprofits.
So they provide the options for employees of institutions to be able to select charities and select organizations that align with their interests. And so they've helped those employees raise $4 billion of donations, but also align kind of the volunteer hours as well to create kind of a more meaningful impact in a large number of areas.
That's awesome.
I mean, Tim, one way I think about this is, writ large, technology has really improved the lives of people around the world. For example, in Africa, most people have smartphones and they transact through that. That's how they do their payments. And what that really enabled is that these countries have skipped the infrastructure part of putting in, you know, optic cables throughout the country, et cetera. They skipped that capital intensive portion and moved right over to wireless. And so, you know, people in impoverished areas in Africa, they still all have mobile phones, and they're using that to transact and obviously to communicate. Another example really would be, you know, Wikipedia. I'm on the board of the endowment there, and you know, this is a free repository of information that's managed by the crowd. And I think that promotion of information, of fact-based information around the world has been very, very meaningful to people. But so you can see that reducing the cost of the distribution of information, reducing the cost of services, I think improves the lives of many people. And it's not just, you know, another fancy way to share videos of one another to their friends. And so a lot has been accomplished. Even Uber, you take an example like Uber and Lyft, you know, car services here in the car sharing services in the United States and around the world, that's actually led to a reduction of drunk driving deaths. And so, you know, I don't know if that was the original intent of those companies, but that's sort of an unintended consequence. And so I think whenever you have an opportunity to lower costs that benefit individuals, I think that that enables you know, the standard of living of people to increase and improve, and also the connectivity between people and their families.
The car sharing area is fascinating because the initial version of Uber and Lyft, a fairly thin technology software layer connecting folks who need extra income and a car with folks who need a ride. And you create a whole new ecosystem, you know, an entire new transportation system with just a little bit of software sitting on top of these amazing platforms that we've built, you know, over the last 30 years in smartphones and cellular networks and all that. Waymo recently went live in Phoenix, where now you can hail a self-driving car as easily as you can hail a car driven by a human. And that's going to be an interesting one to watch, in particular, as cars are the second largest expense for the average income American family. And when those cars break down, it's often the expense that will cause a family to not be able to make it to payday, make their rent. But cars are only used an hour a day, so being able to share a fleet of cars amongst a bunch of subscribers to a car versus actually owning your own could save vulnerable families a couple $100 per month per car, which can be a game changer for whether you make it to payday or not. So a fascinating use of technology and AI there as that continues to roll out everywhere. Talk about banking a little bit.
Thank you.
What's happening with the tech industry and banking?
Well, you know, I think banking, like venture capital, has been pretty effective at disrupting old school industries, and banking and what they call fintech, financial tech. Fintech is one area that's been very positive, I think, where venture capital has had a very positive impact. And so, you know, historically, the large money center banks like the JP Morgan Chases, the Bank of Americas, the Wells Fargos, you know, they basically had they controlled, it wasn't necessarily a monopoly, but they had control of how people operated and worked with banks. And I'd say in the last 10 to 15 years, new startups, which are now probably more established, have disrupted that. They've made it easier to open accounts. It's all online. You don't have to go to a brick and mortar. And actually, by doing that, they've actually reduced the cost of banking. So, you know, it used to be that you're charged ATM fees, you're charged account fees, things like that. That's largely gone away with these newer fintech startups. But that's on the consumer side. And Tim, you have one of the best examples of of this, which is a company called Chime. And Tim is one of the co-founders of this bank, and it's one of the most valuable new banks out there in the world. So maybe I'd love to hear a little bit more from you about that. But from a infrastructure side, there are companies like Stripe, which enable payments, companies like Plaid, which enable people to open accounts. These fintech startups to allow consumers to open accounts relatively easy with the click of a button. And so, and then another one of our portfolio funds has a company called TransferWise, which in Europe has made it very easy for relatively modest income people to do payment remittances. And again, that's an example where these the old school remittance firms would take 20-30% fees in order for a worker in the US to send back money to his family in his home country. And that was very expensive. And again, technology and fintech startups have basically reduced the cost, reduced the friction. And so I think the larger message here is that technology can be used and is being used to disrupt old school industries in order to benefit ultimately the consumer.
It's a pretty fun time to be able to deliver some of these technologies. The bad news is 2/3 of American families are really struggling out there. They struggle to make it to payday. The good news is that is such a large market that you can point venture-backed startups at it and make outsized returns. So it's really fun to look at basically every income and expense item in the average American income's family budget, and then look at the incumbents and the NPS scores. And you find that a lot of them have big market caps, but aren't loved as brands by the average American family. So we've been doing a lot at Pivot North, just looking at every line item and then looking at how to disrupt the incumbents who have large profit margins, but aren't necessarily satisfying the customer well. And we've had good success with a bunch of those. Chime in banking. I've got a new one now, which I'm really excited about, called Godoo. It's GODOLIFE.com. And they allow workers to get access to their wages as they earn them for free. So think of it as a free payday lender. So if you direct deposit your paycheck to our companion bank account, you can get access to wages on the wages you've earned on Tuesday if your rent's due on Wednesday, rather than having to go to a payday lender or take out a cash advance on a credit card. The payday lending industry is a fascinating one to disrupt. 12 million Americans use it every year, and 85% of the loans they give out never can be repaid. So it's a group of people that are bankrupting 10 million plus families a year. And we figured out a way to deliver that service for free with a really great business model that's a win-win for the customers and win-win for us. And so I'm really excited about that as that rolls out. That'll help tens of millions of families a year if we're successful with it. Michael, maybe talk a little bit. Miguel talked about Benevity, which kind of is almost directly connected to the Catholic Church and benefiting the Catholic Church, with 23 million hours of volunteer time generated and 4 billion in donations. We got to get Catholic Charities USA working directly with those folks if we're not already. But there's been some interesting venture financings of companies that are more on the kind of church tech side. You want to talk about companies like Hallow that we're seeing even on helping the church within venture capital?
I'm happy to, yes. So we, across our different fund managers, I think they have a great repository of knowledge and experience in terms of helping build communities. And so I think there has been a lot of interest in church-related community and services using technology. So Hallow is an example of that. And what's really remarkable is to see the growth of the usage by users, and also the the engagement that they have. And I think it gets to the larger point that, there's a lot of issues in the last, decade, I suppose, or even longer, about mental health and actually wanting to have more of a positive, impactful life. And so church-related, companies, you have mental health related companies like Calm, for example. These are very meaningful sized communities, and actually because the value that they provide is so important to the users, that it's also very meaningful sized business. They're meaningful sized businesses. And so I think people realize that being able to buy a t-shirt cheaper is one thing, but being able to think about and contemplate your life and your relationship with God and with others is also just as important, if not more important. And I think there are technology-based startups that are working to provide that solution.
That's awesome. Yeah, so a lot of talk about AI and machine learning and concerns about that. Miguel, can you talk a little bit about that? Is AI inherently bad, or are you seeing companies, startups use it for good?
So I think AI, the way that we've seen it applied for the most part, is really just a continuation of where technology has been before. So, we called it an algorithm before, which was somebody kind of programmed that into computer, versus AI, which learns from people's repeat behavior from multiple data points, and the machine can predict what's going to happen based on what it's seen within the past. The positives to that is you can build significantly better business models using AI. We've seen that applied to some really interesting segments. We've seen it applied within the business world to improve efficiencies. We've seen it applied within the consumer world to really provide better outcomes. So one really interesting application is around mental health. And having kind of better services and better care available to people 24 hours a day, where otherwise, it's very difficult to get a mental health care professional involved with somebody. We've seen some really good results from some businesses within those spaces. We've also seen it be applied to, autonomous driving, autonomous vehicles, and we're not autonomous airplanes, drones that can really do great things for humanity and lower accidents, increase kind of efficiencies in a lot of ways. One of the challenges, just to be totally honest with AI, is that it is a little bit of a black box, because it's the machine that's understanding kind of the regressions and understanding what the data points are doing. And sometimes, that can go the wrong direction. But we are also, we also see groups kind of working on that. So one of the investments that we have within our portfolio is called Credo AI. And what that does is that's a solution that creates an auditable, fair kind of view and a lot of transparency within AI. And so if you see kind of AI or machine learning going in a direction that you don't want, this is kind of the product to help you kind of realign that and make sure that you're not having kind of the negative outcomes that could be associated with the technology.
Tim, when I think about AI, I think about the sort of Isaac Asimov's 3 rules of robotics. And, one of the first rule is a robot cannot harm a human being. Number 2, the robot must listen to the human being, except if it violates the first rule. And then the third rule is, the robot has to protect its own existence as long as it's not violating the first 2 rules. And so, now in my mind, that conjures up the Terminator and, the world where AI has taken over the production of robots that are hurting humans. And that is a world that's completely spun out of control. And now, whereas we're not at that point yet, certainly, the danger of AI is that it can be used to deceive people. And, more recently in venture capital, people are investing in companies that are focused on generative AI. And what that really means is, you could go to a website and and actually type in some inputs, and it will generate a school essay. So for example, you're in college, you don't have time to write an essay. You can use an AI driven program in order to conjure up an essay. Or certainly with in the art world, there's a site that's powered by OpenAI called DALL-E 2. And you can put in some ideas for an image, and it will automatically generate an AI generated image or artwork. And that's all fun, perhaps, but where it could actually become obviously very dangerous is if it's used to sway public opinion, and also to create a false narrative where a large amount of people start believing it and go down the unhealthy path. And so another example of this would be what people call deep fakes, where they're actually using known people. So like you could do a deep fake of Tim Connors in a video and doing something that Tim would never do. And that could create obviously reputational risk. And so, I think there are a lot of opportunities around AI as long as being used in an ethical way. One positive example is that AI, in that example I used of being able to generate a school essay. Well, that same technology can be used to generate code, and it can actually increase the efficiency of software developers in order to develop code and reduce it from weeks or months of developer time into 5 seconds. And so I think there are plenty of examples of that, and I think where AI can be used. I think it has to be done within an ethical framework.
Yeah, I think it's really interesting. We'll turn it over to Zella to ask the audience questions here in a second. Just one comment on this before we do. I think this is why it's ever more important for Catholic investors to be deeply invested as LPs in venture. You get the potential for tremendous outsized returns to help your core mission. But the LPs that ask the right questions about the ethics of everything that's happening on the VC side are tremendous. My Catholic investors in my fund ask me questions that I don't often get from some other LPs, and force everybody to think about what are they funding companies that are helping the world while making outsized returns, or are they hurting? And I think the more the Catholic world gets deeply invested here, the more we can actually solve some of these really core problems for vulnerable families and the planet and the church itself. I've probably never been more excited than I am in my 24 years in venture about how much good can be done with venture if it's in the hands of the right folks who are asking the right questions.
Well said.
Zella, you have some crowd questions?
I know we have a lot of good questions that came in, actually. One of them is SRI related for Catholic institutions. I don't know if you want to take that one, Tim. It says, with such large percentage of the venture market tied to healthcare, how do you navigate for Catholic SRI in general?
Yeah, so my not all, but some of my Catholic LPs send me very regular ESG surveys to fill out and ask all the right questions all the time about how aligned we are with the Catholic mission to serve the vulnerable and Laudato Si and the church itself. So the Catholic LPs are asking all the right questions. I think there's potential for tech companies to do really bad for vulnerable people, and there's plenty of that going on with, for example, these buy now pay later startups that are just another form of payday loans at very high interest rate. I think it doesn't take all the LPs to ask the right questions of the VCs, but when a few of them do, it helps a lot. So I think you're seeing a lot of firms, especially at the seed stage where Michael is, a lot of really good principled people trying to build companies that help, not hurt. the growth investors invest what we fund at the seed stage. So we should have a positive impact going up the chain with it. Healthcare is a fascinating area, and we're hoping that the next revision of the USCCB investment guidelines is much more detailed on alternative assets like venture capital. The last version was primarily focused on public market investing and how you have influence with shareholder activism. On the public side, there's a real opportunity for that document to get a lot more specific and impactful on impact investing and the role of alternatives like venture.
And one of the things that we do as a large fund manager with a lot of differing clients is we really work with our clients to create tailored approaches, and we will, based on particular guidelines, we will carve out certain assets that don't fit the missions of our clients, and so we do have structures in place to help kind of direct capital into the areas that we really want to focus into.
Deal by deal, opt-out rights, yes. Michael, I don't know if you want to add to that. If not, we'll move to.
Zela, let me punctuate that by just saying that both Cendana and Hamilton Lane have been very open to really doing deep dives into Catholic SRI principles, and it's been a real pleasure to work with both firms because they've been very open, as Miguel just said, they've been very open to embracing. We've done a lot of back testing with them, and it's so they've taken a real interest in learning.
One quick thing I would add is that, here at Cendana, I mentioned earlier on this call that we seek to be the lead investor in the funds that we invest in. And that means that we spend a lot of time getting to know the fund manager. And we're not just allocating dollars to a group and saying, good luck, we'll see you in a few years. We're actually working very hands-on. So what that really means is that we look for in terms of the fund manager, aside from the investing ability, we really look for the character and the vision of that person and the team that person is building. So I think, a lot of that may be, sort of hand waving, but I do think that by getting to know the fund manager very, very well, we have a really good sense of how they think about things, their integrity, their goals in life and for their firm.
Well said. Well said. I think this question is on everybody's mind. Are venture investments impacted by recessions in the same way that more established companies are? Tim, did you want to start that one?
Yeah, it's interesting. They, especially the area that I invest in, which is super early stage. We care about what the public markets are going to look like in 6 to 8 years when our companies are doing 100 million revenue and ready to go public. Sometimes some of the growth VCs spend a little too much time looking at their personal investment holdings, and that causes them to whipsaw the early stage a little bit. But the best funding markets by far, when the best companies have been built, is in down markets like this, where it's harder to raise capital. And so the sort of when everything's up and to the right, sometimes folks that aren't really all in as a founder will get excited to start a company. In down markets, only real founders start companies. And when everybody else is kind of sitting on their hands, it's a phenomenal time to invest. So it should be fairly uncorrelated to the public markets, but there's some humans in the mix deciding which companies get each incremental round of capital, which sometimes causes them to whipsaw a little bit. I had one company recently that I funded that if it had been a normal market or an up market like we've had, they probably could have raised 3 times, 4 times as much money at probably 5 times the price that I was offering. But I was able to get a really great pair of founders to do a deal with me at a fairly modest valuation at my target ownership. And it's a great company. They're going to try to, Facebook causes hundreds of millions of people a year to have more anxiety and depression with the way their social network is designed. And these folks want to build a social network that actually helps people get together in person more rather than being in virtual more. And they've got a really great idea on how to monetize it with local merchants benefiting by being the forum at which these folks meet up in person. So, that's a company where, it's great when other people are not investing. If you're actively investing, that's when you find the best founders and get the best deals.
Right. I would add that, you basically cannot time technology innovation. So for example, when Lehman Brothers went bankrupt in September of 2008, the world financial markets had that complete meltdown. Within 6 to 9 months of that event, companies like Uber, Airbnb, Pinterest, Slack, they were all formed in that sort of nuclear winter. And what that suggests to me is that the founders there had the grit and determination to persevere and make it through. Obviously it became a better venture market in the past 10 years, and more capital was available to good companies. And, I think one way to look at last year was sort of an overexuberance of capital being used to fund companies, and the companies were told basically to grow at any cost. And again, I think when you have scarcity of capital, when capital is expensive, you don't focus on buying bad revenue. $2 paid in order to get $1 of revenue. That kind of world is gone away. And I think the gritty founders are very much focused on persevering and making sure that their companies actually have positive unit economics. The other thing I would add, and this is both for my firm and Miguel's, as fund of funds, what I would say is that we actually have a lot lower risk. And the reason why I say that is because, if you think of a continuum where investing in one company, that might have the highest reward. Let's say you invested in Facebook as a seed investor. That's an amazing, outcome. But, the probability of one company going under is relatively high. If you look at a venture capital firm, they have a portfolio of companies. So they're diversifying to some extent by number of years and also by number of companies. But if you look at a fund of funds, our fund of funds have 700 to 800 companies in each one of our vehicles. And the obviously diversified by geography and sector, but most importantly, it's that time. So we are allocating to fund managers over 3 years, and the underlying fund managers are investing over 2 to 3 years. So we actually capture 5 to 6 vintage years of companies. And so we feel that actually helps mitigate any sort of near-term economic distress or a recession.
And not to belabor this too much, but one of the things that we manage, we have a $16 trillion database of private market data. And so we spend a lot of our time taking a look at how different strategies perform through different market cycles. And the venture industry is the least correlated to the public markets of all the others for the reasons that Michael and Tim just mentioned. But there's a lot of kind of offsetting factors. One is venture is a long-term asset class, so you really care about what the market looks like 5 to 10 years from now, not today. During downturns, there's kind of better availability of human capital. So people who have been laid off are more likely to start new businesses, and it's cheaper to hire people. It's cheaper to advertise and buy Google Words and AdWords and help drive growth within the business. And so you can really take advantage of this market cycle if you have the right strategy.
Well said. I think we have time for maybe one more question, and this one is about governance. Can we speak about the general governance structure of these early stage companies? It seems like it may not be very well developed. Michael, I don't know, do you want to start that one?
Well, I can start from top down. So when an investor like Miguel or myself invest in a fund, generally we join what's known as the LP advisory committee. And so that is actually the governance board of a fund. And different fund managers use those the LP advisory committees in different ways, but ultimately there are legal provisions in a LP agreement that articulate how what a fund manager can and cannot do. So if there's ever sort of conflicts of interest, the LP advisory committee reviews that and discusses it with the fund manager. If a fund manager wants to invest more than say X% of their fund in a particular company or geography, again, the LP advisory committee looks at that. And actually, in almost all LP agreements, the LPs can actually terminate a fund manager or the fund, and then find an alternative manager to manage out the rest of the fund. So, generally speaking, the LP have substantial influence over a fund manager's I wouldn't say investment activities, but to some extent, yes. But in general, in ensuring that there's good governance at the fund level. I don't know, Tim, if you want to talk about working with companies specifically.
Yeah. As Michael said, folks like Michael and I are in sync all the time, talking all the time. And then when I turn around and fund a startup, at the early stage that I fund them at, maybe 5% of the value is the capital and 95% is the coaching. And so it's rare that a day goes by or two goes by where I'm not texting, calling, emailing in response to one of my founders' questions or needs. So it's very much hands-on, especially in those early days. Folks got away from best practice for a little while in some of this kind of crazy crypto stuff that's been going on. Probably read about FTX, where there didn't appear to be a board or anybody paying attention. Yet there were some luminary, VC firms in those as investors in those companies. So every once in a while, something gets a little messy. A Theranos. You look at some of these blow-ups, and usually there's a root cause where there wasn't a strong board there. But I'd say those are probably 1% of the cases. 99% of the cases in startups, the board and investors have a pretty good handle on what's going on in the companies. And then as you get bigger, the boards get bigger, and they're as you get to IPO, then they're fully built out with a good number of independents alongside the venture investors.
Well, Tim, Miguel, Michael, I feel like we're just getting going here. We really we need to do part two of this, because you've just been incredible. You provided some incredibly valuable information for our audience, and I know we'll try and follow up with the questions that we couldn't get answered. But really, very grateful for your participation today. I think the audience realizes how lucky we were to have you, and so thank you, and look forward to moving forward. And again, to our audience, we have a quick survey that we hope you'll fill out, and you have, from all of us, you have our best wishes for blessed and happy holidays, and thanks for joining us today. And again, thanks to our great panel.
Thank you.
Thank you.